My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job, not just to entertain, but to educate, teach, coach. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. There's the real world, and then there's the stock market world. Those are two very different animals. And that's how we could have a day like today where the NASDAQ got spanked, down 0.44%. The S&P 500 backslid 0.16%, but the Dow Jones Industrial Average rallied 29 points in anticipation of the Fed's upcoming rate cut, the first in 10 years. Allow me to set the stage. On Wednesday, Fed Chief Jay Powell will give us his read on the economy and hopefully announce a quarter-point rate cut to breathe new life into what has become a moribund business situation for many different industries. Now, I know there'll be some sticklers who say that with unemployment at this lowest level since the 1960s, it is ridiculous for the Fed to even think about cutting rates. Others, like President Trump, think a 25 basis point cut isn't enough. The president has endlessly tweeted that the Federal Reserve's way too tight monetary policy has been holding back the economy. Did it again today. And he's not wrong. When your interest rates are too high, your currency gets stronger versus the rest of the world. Right now, our rates are much higher than the other developed countries. So the dollar is very strong, and that makes our internationally oriented companies far less competitive. We also know it can hurt the auto industry when you have higher short-term rates and the housing industry, both of which are weak right now. Powell's no dope. To his credit, he realizes that the last rate hike in December was a rate hike too far. It shocked the confidence out of the business community and caused a mini bear market in stocks that it took 6 months to recover. So Powell wants to cut rates, and he has all the justification he needs, thanks to the uncertainty caused by, yes, the president's trade war. We know Trump's tariffs have slowed the economy. We've heard it on conference call after conference call after conference call after conference call, where executives keep complaining that the tariffs have frozen expansion. Last week, we spoke to Nick Akins. He's the CEO of American Electric Power, neutral, but the largest power transmission company in the country. And he told us about the slowdown in power consumption. It's real. It's not something that is fungible or political, okay? Normally, the Fed might be reluctant to start cutting so soon after the last tightening, because nobody likes to admit when they've made a mistake, and isn't that kind of what's happening? But Powell can just blame Trump. He doesn't have to take responsibility for the rate hike too far, and that makes it easier for him to do the right thing. Now, it's not just the tariffs. Boeing may need to halt production of the 737 MAX, and if that happens, do you know it could knock a half a percentage point off our GDP growth? Yes, that's how important Boeing is to the economy. Plus, there are tons of ailing retailers. I would mention them. Their stocks all traded at $1 or less. We can't talk about them, but there are going to be some major layoffs as we get closer. Maybe they make it to the holiday season. Maybe they don't. In short, when you look at the landscape, I think it's clear that we actually do need a rate cut. If the Fed doesn't deliver, it'll be very bad for the economy because of the confidence shock. But how about stocks? What does this upcoming quarter-point rate cut mean for the stock market, for your portfolio? Now, if you only look at the numbers, a quarter point doesn't do much, right? But when you look beyond the numbers, it's a very big deal. Let me tell you why. For starters, business people are going to be more gutsy about expanding their enterprises once they know the Fed is on their side. That's how it does work. They'll also be emboldened by the possibility that the strong dollar could finally start to cool down. It has been a major theme in every quarter. Every conference call that's international is like the dollar, of course, the dollar. It would be a gigantic win for our exporters, something that translates directly into higher earnings. More importantly, a quarter-point rate cut will have a much larger impact on the market than it does on the economy. That's because money managers have seen this movie before. They have what I call a playbook. It's a playbook for what to do when the Fed starts easing. You sell high-growth stocks that can thrive in any economic environment, and you buy the cyclicals, the industrial companies that can deliver big earnings beat when the economy accelerates because the Fed cuts. Now, here's the thing. Here's the thing about the playbook. It could be wrong. Maybe a rate cut won't boost auto sales. So you shouldn't buy industrials with auto exposure like 3M or Illinois Tool Works or Lear. Maybe it won't trigger more construction. So you should avoid Caterpillar, United Rentals, or Union Pacific. But, and this is the world's biggest but, it doesn't matter right now if the playbook's wrong. Money managers know that you don't fight the Fed, you don't fight the tape, which means you don't go against the playbook that says buy every one of those stocks. What does it mean for you? Okay, last week Caterpillar reported a subpar quarter when many people, including myself, mea culpa, thought the numbers would come in better than feared, or BTF. It didn't work out that way, and the stock got slammed, falling from 138 to 131. However, CAT is exactly the kind of stock the playbook says you must buy it with your eyes closed because of the rate cut. And now it's making a comeback. $1 and change today. So as CAT goes, by the way, so go the other industrials. CAT has more pin action than any stock I follow. How about the super growth stocks? Oh, they got pummeled again today. Something has become a common theme ever since ServiceNow and PayPal reported numbers that Wall Street didn't like. I actually thought ServiceNow delivered a good quarter. We heard from CEO John Donahoe last week on the show. He told a compelling story. Do you know, I went back over it again today. I thought maybe I missed something. I said, okay, let me just reread the transcript. Let me reread the speech. No, it was great. However, the playbook is spoken, and that's why the stock's down a quick $12. PayPal, on the other hand, actually deserves to go down as the company cut guidance. But the pin action from these two has been extreme. And it's all thanks to the Fed-induced rotation. Don't believe it when people say the stocks going down must mean the companies are slowing. It's not. It's the rotation speaking. So what should you do about this rotation? Honestly, while I want you to be aware of what's going on, hence what I've just been talking about, I think it's a mistake for you to try to trade this kind of rotation if you're a home gamer. Matter of fact, I'll go one step further. The stocks now that are going down are the highest quality companies in this entire market. CloudCase, Salesforce, Workday, VMware, Splunk, Twilio, Adobe. These are excellent companies, but their stocks rarely give you any kind of viable pullback. When you see a Fed-induced rotation like this one, it means you can finally buy the Cloud Kings at a discount. But remember, there's no hurry. We have to let the whole rate cut drama play out. There are always late to the party fund managers who will only figure out what I just told you after the Fed takes action on Wednesday. And maybe that's when you make your move. And the cyclicals, look, they're cheap. They might see better business. There's a cyclical scarcity out there, just not enough stocks. But you have to deal with the endless trade talks with China, and I don't necessarily think they'll be fruitful. If the negotiations blow up, that will stop the industrial rally in its tracks, regardless of the Fed. But the turbocharged growth kings, come on, they'll do fine no matter what, because they're riding the greatest secular trend out there, the digitization of all business. More on that later. Bottom line, you need to accept that this rotation is happening. It's what's driving these stocks. The Fed's rate cut will push money out of the Cloud Kings and into the industrials. But your job is not to trade around a rotation. It's to find high-quality stocks and stick with them for as long as the underlying business stays strong. So when this kind of rotation gives you a pullback in a group like the Cloud Kings, that's a long-term buying opportunity. Just remember that you can afford to take your time. Again, there is no hurry. But you have to start sometime. And as it goes on, I don't think the rotation's over. This rotation will be the best time to buy the stocks that we like so much in Mad Money. Let's go to Miles in Virginia. Miles.
Hey, Cramer, big fan of yours in the show.
Thank you.
Quick shout out to my investment team over at Christopher Newport University in Virginia. My question is about Enterprise Products Partners, EPD. They've been up since announcing their dividend increase last month, but I was wondering your thoughts on them for the long haul. Their ex-dividend date is tomorrow, and they announced earnings Wednesday morning. Should I get in now, wait until after earnings, or stay out completely?
I think the quarters could be excellent. I'm relying on Rusty Brazil from RBN. .com. Here's the deal. This is the only one in the entire group that's got any real growth, and that's why it's up 20% and why the dividend can keep going, distribution can keep going higher. It is the company that's doing the most with the natural gas out there. All the other companies should be watching what EPD does, because they're the best at it. I like the call. Ashwin in California. Ashwin.
Hey, Jim, thank you so much for taking my call.
Of course.
My question is on Planet Fitness, PLNT.
Yes.
What do you think? They have a partnership with Kohl's also?
Look, I think here's the story with Planet Fitness. A lot of people feel the growth has run out. That's why they're like going to places like Kohl's. I think that's nonsense. We like Chris Rondo. We like his story. We like how he got there. We like what he's saying. As far as I'm concerned, this decline is a buying opportunity. Planet Fitness. All right, the financial world and the stock world, they're very different at times. But no matter what, you never fight the Fed and you do not fight the tape. On Mad Money tonight, a red-hot stock that's up more than 80% this year, earlier today tumbled announcing a deal. The but then the stock recovered. Should you be concerned about the initial reaction or the later reaction? I'm talking to CEO of Exact Sciences. We've long been fans. You get the facts. Then are the stocks of Amazon and Google telling different stories? You know what I'm going to do? I'll go off the charts to find out what the heck is happening with tech. And time to go for the gold. I've got an exclusive with the CEO of Agnico Eagle Mines. Long my favorite growth gold. Stick with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.